Not so cool today. We've actually already seen 2 price target uppings this morning. So you can see that that's probably going to be a good sign for this stock. As you mentioned, as much as 15% after hours yesterday. It was a big beat. Earnings per share came in at 89 cents. That's compared to 68 cents estimated. Revenues were in line. And the big story here is subscriber growth. We saw an addition of 7 million subscribers. Netflix itself had forecast 5 million, and that's globally. So huge beat on subscriber numbers, and they're also expecting 9 million new subscribers next quarter.
So what happened with the 1 million missing subscribers? Because last time the company reported there was a huge miss, which gave analysts the perception that there was something badly going on behind the scenes. Now we have a beat, so we still don't have any clarity on those subscribers.
We don't, and the only thing that CEO Reed Hastings said on the call is that he attributes that to fluctuations in the way that they calculate the numbers. They actually announced they're going to only focus on paid memberships going forward, and he hopes that that might eliminate some of the seasonality in the quarterly numbers. But they seem to say this was a blip. This isn't the start of a slowdown. There's much more growth ahead, and we expect to have strong subscriber growth going forward.
Fantastic. Amazing, great, but they haven't got purchasing power. And this is my problem with Netflix. I think Netflix is an extraordinarily good company and it's done extraordinarily well, but I have real issues with it. I have issues with the fact that the valuation is off the Richter scale. I have issues with the fact that you've still got massive negative free cash flow, despite the fact that we're seeing such brilliant numbers, i.e. monetizing that fantastic subscriber growth is very difficult. I know the free cash flow outage was less than many had expected as well, but this is my problem just looking at the broader landscape, and I'm just talking as a punter here. Now, I'm going to hold my hand up. Mrs. Sedgwick has Now TV, which is a Sky product. Mrs. Sedgwick has, actually, it's a Comcast product, I should say. Now we own them. Kind of. She has Prime, Amazon Prime, and she also has, on her third hand, Netflix as well. So she has 3 subscription services. She doesn't yet have a Disney subscription service. She doesn't yet have an individual studio one for the others. It will come because I know her. But there is no pricing power for any one of these streaming units as well. And that is my issue. People are still paying, whether it's $7.99, $8.99, $10 per month as well. So how do they monetize these extraordinarily high production costs? How do they justify these extraordinarily high valuations when the fact is you haven't got a monopolistic position where you can up your pricing or own the content?
So what Netflix is saying is that we are going to justify whatever our subscriber fees are because of the original content that we're producing. They sort of divide their content into 3 buckets, and currently where they're focusing that effort is on original content, whether that's in domestic markets, on movies, or on new shows internationally as well. So they seem to think that that's going to be enough to continue to have people pay those separate fees for now.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.